Listen, I want you to picture something. A Wednesday morning in April of 2026. A kitchen table in a townhouse in Raleigh, North Carolina. Her name is Christine. She is 61 years old. She spent 26 years as a hospital pharmacist. She is meticulous by profession and by temperament. She double-checks dosages. She cross-references interactions. She does not make careless mistakes with things that matter. Christine retired 8 months ago. She has a traditional IRA with $380,000 in it. She has a 401k from her first employer that she rolled into a rollover IRA 12 years ago. She has a taxable brokerage account at Schwab with $145,000, and she has a Roth IRA with $94,000 that she opened in March of 2024, 26 months ago. When she opened the Roth, she was 58 years old. She had been meaning to open one for years. Her financial planner had mentioned it at multiple annual review meetings. She finally did it. She contributed $7,500, the maximum allowed for someone over 50 in 2024. She contributed another $7,500 in 2025. She is planning to contribute the maximum again in 2026 before the deadline. Christine thinks the Roth is a tax-free account. She is correct. She thinks the money in the Roth will come out tax-free when she needs it. She is partially correct. She thinks that because she is 61 years old and past the age 59.5 threshold for penalty-free withdrawals, she can take money out of the Roth whenever she wants without owing any tax or penalty. She is wrong. Not slightly wrong. Materially wrong in a way that will cost her $19,000 to $23,000 in unexpected taxes if she withdraws the full Roth balance during a financial emergency in 2026 without understanding the 5-year rule. Christine has a Roth IRA that is not yet 5 years old. The account was opened in March of 2024. The 5-year clock for qualified distributions from a Roth IRA starts on January 1st of the first tax year for which a contribution was made to any Roth IRA owned by the taxpayer. Christine made her first Roth contribution in March of 2024. The clock started on January 1st of 2024. The 5-year period is complete on January 1st of 2029. In 2026, the Roth IRA is 2 years into a 5-year requirement. The earnings inside the Roth, meaning the investment growth above the $15,000 in contributions Christine has made, are not yet qualified for tax-free distribution. If Christine withdraws the entire $94,000 Roth balance in 2026 during a financial emergency, the $15,000 in contributions comes out tax-free and penalty-free, because contributions can always be withdrawn without tax or penalty at any age. The $79,000 in earnings, which includes the investment growth the account has accumulated, is a non-qualified distribution because the 5-year clock has not completed. Non-qualified Roth earnings are taxable as ordinary income and subject to a 10% early withdrawal penalty under Internal Revenue Code Section 72T, unless an exception applies. Christine is 61. She is past age 59.5. The age 59.5 exception to the 10% penalty applies. So the 10% penalty does not apply. But the ordinary income tax on the $79,000 of non-qualified earnings does apply. At Christine's combined federal and North Carolina state marginal rate of approximately 22% federal plus 4.5% North Carolina, the tax on $79,000 of non-qualified Roth earnings is approximately $20,855. Christine thought she was withdrawing tax-free retirement savings. She is paying $20,855 in ordinary income tax on investment growth inside an account she was specifically told is tax-free. That is the Roth clock reset trap, not the standard 5-year rule that most Roth articles mention in passing. The specific trap is the interaction between 3 distinct 5-year clocks that govern Roth IRA distributions, each operating independently, each resetting under different circumstances, and each carrying different tax and penalty consequences when violated. Most Roth IRA education covers one of the 3 clocks. The one that says, wait 5 years and you get tax-free growth. The trap exists in the other 2 clocks. The conversion clock that applies to each Roth conversion separately for penalty purposes, and the inherited Roth clock that resets at the original owner's death for the beneficiary's 5-year requirement calculation. 3 clocks, 3 different sets of consequences. 3 separate ways that a retiree who believes the Roth is simply a tax-free account walks into a taxable withdrawal they did not anticipate. Smash the like button right now. Roth IRA education is dominated by the marketing message that Roth is tax-free growth and tax-free withdrawals. The 5-year rule is mentioned in footnotes and parenthetical disclosures that almost nobody reads, and almost no financial planner explains in the specific context of a recently opened account or a recently executed conversion. Every like on this video puts this analysis in front of one more Roth account holder who is planning their distribution strategy around an assumption that the clock has already run when it may have only recently started. Hit it, subscribe, flip the bell. The suits and legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of Internal Revenue Code Section 408A and the Treasury regulations governing Roth IRA qualified distributions, and the 3 distinct 5-year requirements that determine when Roth earnings and converted amounts are subject to tax and penalty. Consult a fee-only fiduciary who has modeled the 5-year clock status on your specific Roth accounts. What I can do is show you the mechanics and the math. Let me start with the statutory foundation. Because the Roth IRA tax treatment is governed by Internal Revenue Code Section 408A and the qualified distribution rules under Treasury Regulation Section 1.408A-6, a qualified distribution from a Roth IRA is excluded from gross income entirely, not subject to federal income tax, not subject to the 10% early withdrawal penalty, tax-free and penalty-free. A distribution qualifies as a qualified distribution when 2 conditions are simultaneously satisfied. First, the distribution is made after the 5-year period beginning with the first tax year for which a contribution was made to any Roth IRA of the owner. Second, the distribution meets one of 4 additional requirements. The owner is at least 59.5. The owner is disabled. The owner has died and the distribution is made to a beneficiary or estate. The distribution is used for a first-time home purchase up to a $10,000 lifetime limit. Both conditions must be met simultaneously. Age 59.5 satisfies the second condition. The 5-year period satisfies the first. A Roth owner who is 65 years old but opened their first Roth IRA 2 years ago meets the age requirement but not the 5-year requirement. Their Roth earnings are not qualified and are subject to ordinary income tax when distributed, even though no 10% penalty applies because of the age exception. This is the trap Christine walked into. She is 61. She cleared the age threshold 2 years ago when she turned 59.5. She did not open a Roth until March of 2024. The 5-year clock started January 1st, 2024. The 5 years complete January 1st, 2029. Every distribution of earnings before January 1st, 2029 is a non-qualified distribution taxable as ordinary income, even though no penalty applies. Now let me identify all 3 Roth clocks and show you where each one resets and what the consequence is when each one fires. Clock 1. The qualified distribution 5-year clock. This is the clock Christine's situation illustrates. It starts on January 1st of the first tax year for which any contribution is made to any Roth IRA owned by the taxpayer. It is a one-time clock that, once started, runs for any subsequent Roth IRA the taxpayer opens. If Christine had opened a Roth IRA in 2010, contributed $1, and then closed it, the qualified distribution clock started in 2010. Any Roth she opens subsequently, including the one she opened in 2024, inherits the 2010 start date. The clock would have been complete in 2015, and all subsequent earnings would be qualified. The critical insight is that the qualified distribution clock is taxpayer level, not account level. One Roth opened early, even with a tiny contribution, starts the clock for all future Roth accounts. The retiree who opens their first Roth at 58 resets nothing. The clock starts fresh at 58 and the 5 years must run from that point. The retiree who opened a Roth at 40, even if they closed it years ago, has a completed clock that applies to every Roth they open subsequently. The question to ask immediately is not how old is this specific Roth account. It is when did I open my first Roth IRA of any kind. Clock 2. The Roth conversion 5-year clock. This is the clock most often misunderstood because it operates independently of the qualified distribution clock and carries a different consequence. When a taxpayer converts pre-tax traditional IRA assets to a Roth IRA, each conversion is subject to a separate 5-year holding period for purposes of the 10% early withdrawal penalty under Internal Revenue Code Section 72T. The rule is this. If a converted amount is withdrawn from the Roth within 5 years of the conversion, the amount withdrawn that was previously taxable at conversion is subject to the 10% penalty, unless the taxpayer is age 59 and a half or older, or another exception applies. The conversion clock fires the 10% penalty, not the ordinary income tax. The converted amount was already taxed as ordinary income in the year of conversion. It cannot be taxed as ordinary income again at withdrawal. But the 10% penalty can apply if the conversion 5-year clock has not run and the taxpayer is under 59 and a half. For taxpayers over 59 and a half, the conversion 5-year clock is largely irrelevant to the penalty analysis, because the age exception eliminates the 10% penalty regardless. But it matters enormously for taxpayers who execute Roth conversions before age 59 and a half and who might need to access the converted funds within 5 years. A 55-year-old who converts $100,000 from a traditional IRA to a Roth and then withdraws the converted amount 2 years later owes the 10% penalty on the withdrawn converted amount, even though the amount was already taxed at conversion. A separate 5-year clock runs for each conversion. A taxpayer who converts $50,000 in 2023 and $60,000 in 2024 has 2 clocks running simultaneously, each with its own 5-year holding period for penalty purposes. For taxpayers under 59 and a half who are executing a Roth conversion ladder as a pre-retirement income strategy, the conversion 5-year clock is the mechanism that determines when each batch of converted funds becomes penalty-free accessible. The ladder strategy requires starting conversions at least 5 years before the anticipated distribution date. Conversions started at 55 become penalty-free accessible at 60. Conversions started at 57 become penalty-free accessible at 62. The ladder only works if the planning starts early enough for each rung to complete its 5-year period before the distribution is needed. Clock 3. The inherited Roth IRA 5-year clock. This is the clock that catches the beneficiary who inherits a Roth IRA from an account owner who had not yet completed the 5-year qualified distribution period at the time of death. The inherited Roth IRA is subject to the same 5-year requirement as any other Roth IRA for purposes of qualified distributions. The beneficiary's 5-year clock does not restart at the beneficiary's own first Roth contribution date. The inherited Roth IRA uses the original owner's Roth holding period, meaning the 5-year clock that began when the original owner first established any Roth IRA. If the original owner had a completed 5-year period at death, the inherited Roth earnings are immediately qualified for the beneficiary, regardless of whether the beneficiary has their own Roth IRA with a completed 5-year period. If the original owner had not completed the 5-year period at death, the beneficiary must wait until the original owner's 5-year period completes before the inherited Roth earnings become qualified. For Christine's situation, if she dies in 2027, with the Roth having been open for 3 years, the 5-year period is not yet complete. Her heirs inherit an IRA with a 2-year remaining qualification window. If the heirs distribute the Roth earnings before January 1st of 2029, when Christine's original 5-year period completes, those earnings are non-qualified and taxable as ordinary income. The heirs must wait until 2029 for the earnings to become fully qualified, just as Christine would have had to. The inherited Roth 5-year clock is not the beneficiary's clock. It is the original owner's clock, carried forward into the inherited account. Tell me in the comments right now. Tell me when you opened your very first Roth IRA of any kind. Tell me the oldest year for which you made a Roth contribution. Tell me the balance in your Roth and the approximate contribution amount versus the earnings component. Tell me your state. Drop it in the comments. I read every single one. We calculate your qualified distribution eligibility date together, and if the 5-year clock has not yet run, we identify the exact date when your Roth earnings become fully qualified. Now let me walk through the 4 strategic responses available to the retiree who discovers that their Roth 5-year clock has not yet completed and who needs to access funds before the qualifying date. Strategy 1. Withdraw contributions first, earnings last. The Roth IRA has a specific ordering rule under Treasury Regulation Section 1.408A-6 that determines which dollars come out first when a distribution is taken. The ordering is contributions first, then converted amounts in chronological order of the conversion, then earnings last. Contributions come out first, and they always come out tax-free and penalty-free regardless of age or the 5-year clock. The 5-year requirement applies to earnings. If Christine needs $30,000 from the Roth in 2026, and she has $15,000 in contributions, she can withdraw the $15,000 in contributions tax-free, and then access $15,000 of earnings that will be taxable as ordinary income since the 5-year clock has not run. The ordering rule means that the 5-year clock issue primarily affects the earnings component. The contributions are always available without tax consequence. For a recently opened Roth with contributions significantly exceeding earnings, the ordering rule provides meaningful protection. For a Roth with substantial earnings relative to contributions, as would be the case for an account held for several years with strong market performance, the ordering rule provides partial but not complete protection. Strategy 2. Use alternative liquidity sources during the 5-year window. The 2 to 3 years remaining before the Roth 5-year clock completes in 2029 represent a window during which Christine should prioritize other liquidity sources over Roth earnings for any distribution needs. The traditional IRA generates ordinary income on every distribution, but the traditional IRA does not have a 5-year waiting period. If Christine needs $50,000 for a home repair or medical expense in 2027, the traditional IRA is the correct source, even though the distribution is taxable as ordinary income. The Roth contributions up to $15,000 can supplement the traditional IRA distribution tax-free. The Roth earnings should be preserved inside the account until January 1st of 2029, when they become qualified and tax-free. The holding cost of this strategy is the opportunity cost of continuing to hold the Roth earnings in the account rather than accessing them immediately. But the tax cost of accessing non-qualified earnings before the clock runs is approximately $20,855 on $79,000 of earnings at Christine's combined rate. Waiting 33 months to avoid $20,855 of ordinary income tax on those earnings is clearly superior in nearly every realistic scenario. Strategy 3. Optimize the timing of the first Roth contribution to maximize the 5-year period in future planning. For anyone who does not yet have a Roth IRA and who is planning to open one, the timing of the first contribution determines when the qualified distribution clock starts. A contribution made in December of 2026 starts the 5-year clock on January 1st of 2026, because the clock starts on January 1st of the tax year for which the contribution is made, not the calendar date of the contribution itself. A contribution made in April of 2027, after the tax filing deadline but attributed to tax year 2026 through the prior year contribution election, also starts the clock on January 1st of 2026. The strategy for someone approaching retirement who has not yet opened a Roth is to make the first contribution as early as possible in the planning timeline, attributed to the earliest possible tax year, to start the 5-year clock running. Even a minimal contribution in a given tax year starts the clock. A $500 contribution in December of 2025, attributed to tax year 2025, started the 5-year clock on January 1st of 2025. The 5-year period completes on January 1st of 2030. Combined tax, approximately $24,727 on $79,000 of earnings. The California non-qualified Roth distribution is approximately $3,792 more expensive than Christine's North Carolina distribution and approximately $7,347 more expensive than the Texas equivalent. Start the clock as early as possible. Make the smallest permissible contribution in the earliest available tax year if a larger contribution is not possible. Get the clock running. Strategy 4. For Roth conversions executed as part of a pre-retirement income strategy, calendar the conversion 5-year clocks precisely. Each Roth conversion creates a separate 5-year clock for penalty purposes for taxpayers under 59.5. For taxpayers over 59.5, the penalty clock is irrelevant because the age exception eliminates the 10% penalty regardless. But for the taxpayer in their mid to late 50s who is executing a Roth conversion ladder to fund early retirement before 59.5, the conversion clocks must be calendared precisely to ensure each batch of converted funds completes its 5-year period before the planned distribution date. Use a simple spreadsheet. Column 1 lists the conversion year. Column 2 lists the converted amount. Column 3 lists the penalty-free accessible date, which is 5 years after the conversion year. No distribution of a converted batch should occur before the penalty-free date if the taxpayer is under 59.5 and no penalty exception applies. The calendar discipline is the entire mechanism that makes the conversion ladder strategy work. Without it, each distribution from the ladder triggers a 10% penalty that negates a significant portion of the tax efficiency the ladder was designed to create. Now let me give you the geographic dimension because the state tax interaction with non-qualified Roth distributions adds a meaningful additional cost that varies significantly by state. In North Carolina, where Christine lives, the state income tax rate is a flat 4.5% on all ordinary income, including non-qualified Roth earnings. Christine's $79,000 of non-qualified Roth earnings, subject to ordinary income tax, generates $3,555 in North Carolina state income tax, in addition to the $17,380 in federal income tax at the 22% bracket. Combined tax, $20,935 on the $79,000 of earnings. In Texas, there is no state income tax. Christine's equivalent in Texas pays only the federal 22% on the non-qualified Roth earnings. Total federal tax on $79,000 at 22%, approximately $17,380. The Texas Roth account holder pays $3,555 less than Christine on the same non-qualified distribution simply because of state of residence. In California, the state income tax rate reaches 9.3% at income levels comparable to Christine's. The California equivalent of Christine's $79,000 non-qualified Roth earnings distribution generates $7,347 in California state income tax, in addition to the federal ordinary income tax. Combined tax, approximately $24,727 on $79,000 of earnings. The California non-qualified Roth distribution is approximately $3,792 more expensive than Christine's North Carolina distribution, and approximately $7,347 more expensive than the Texas equivalent. For California residents with recently opened Roth accounts, the 5-year clock management is even more financially significant than in lower tax states, because the state penalty for non-qualified distributions is the highest in the country. In Florida, no state income tax applies. The Florida equivalent pays only the federal rate on non-qualified Roth earnings, identical to the Texas situation. The combined 5-year clock management advantage in Florida and Texas is approximately $3,500 to $7,300 more valuable than in high-income tax states in absolute dollar terms on the same non-qualified distribution amount, because the absence of state income tax reduces the total cost of the non-qualified distribution and therefore reduces the total savings from proper 5-year clock management. Now let me give you the 5-step action sequence. What Christine does right now and what every Roth account holder does in the next 30 days to determine their qualified distribution eligibility status and to plan their distributions accordingly. Step 1. Identify the earliest tax year for which any Roth contribution was ever made. This requires reviewing historical tax records, specifically Form 5498, which reports IRA contributions, for all prior years in which a Roth contribution was made. If that year is 2021 or earlier, the 5-year qualified distribution clock has already completed, and all Roth earnings are currently qualified for tax-free distribution, assuming age 59.5 is also satisfied. If the earliest Roth contribution was made in 2022 or later, the 5-year clock has not completed, and earnings distributed before the 5-year anniversary are non-qualified and taxable. Step 2. If the qualified distribution clock has not completed, calculate the exact completion date. The completion date is January 1st of the 6th year after the first contribution tax year. First contribution in tax year 2022 means completion on January 1st of 2027. First contribution in tax year 2023 means completion on January 1st of 2028. First contribution in tax year 2024 means completion on January 1st of 2029, as in Christine's case. Step 3. Separate the Roth account balance into its contributions component and its earnings component. The custodian's records or the historical 5,498 forms should document the total contributions made to the Roth over all years. Subtract the total contributions from the current Roth balance to identify the earnings component. Only the earnings component is subject to the 5-year qualified distribution requirement. Contributions are always distributable tax-free and penalty-free. Step 4. Build a distribution sequencing plan that accesses contributions before earnings during the period remaining before the qualified distribution clock completes. Any Roth distributions needed before the completion date should be limited to the contributions component whenever possible. Distributions needed beyond the contributions component should come from alternative liquidity sources, the traditional IRA, the taxable brokerage account, or other available funds, rather than from Roth earnings that are not yet qualified. Step 5. For conversion-funded Roth accounts used in a retirement income ladder, calendar the specific penalty-free date for each conversion batch. If any converted amounts remain within their 5-year conversion clock period, and the taxpayer is under 59.5, mark the penalty-free dates prominently in the retirement income calendar. Do not distribute converted amounts before their penalty-free dates without first confirming that the age exception or another qualifying exception eliminates the 10% penalty. Save this video to your private library right now. Hit the bookmark. Add it to the Retirement Survival playlist. Because the Roth clock reset trap is the consequence of a knowledge gap between the marketing message, Roth is tax-free, and the statutory reality, Roth earnings are tax-free after the 5-year qualified distribution period is complete and not before. Christine is a pharmacist. She double-checks dosages and cross-references drug interactions by professional instinct. She did not double-check the Roth 5-year clock because nobody told her it existed as a separate requirement from the age 59.5 threshold she already met. The marketing of Roth accounts consistently emphasizes the age threshold because it is the threshold that applies in most cases after the 5-year period has run. It does not emphasize the 5-year period because the 5-year period is not a problem for anyone who opened a Roth more than 5 years ago, and because emphasizing it would reduce the urgency to open a Roth immediately, which is the marketing message most financial institutions want to send. Subscribe if you have not, flip the bell, comment with the earliest year you made a Roth contribution of any kind. Tell me your current Roth balance and the approximate split between contributions and earnings. Tell me your state. We calculate your qualified distribution status together. I read everything. The Roth IRA is the most powerful tax-advantaged account in the American retirement system when used correctly. Tax-free growth, tax-free distributions, no required minimum distributions during the owner's lifetime, no provisional income contribution to the Social Security taxation formula, no IRMAA trigger from Roth withdrawals. The benefits are real. The 5-year requirement is real. The 3 clocks are real. And the trap is the assumption that opening the account and reaching 59.5 is sufficient to access all of those benefits tax-free without modeling the clock. Check the clock. Find the oldest Roth year. Calculate the completion date. Build the distribution plan around the completion date. The tax-free withdrawal Christine is planning in 2026 has a $20,935 price tag attached to it that disappears completely in 33 months, when January 1st of 2029 arrives. Wait 33 months. Use the traditional IRA in the interim. Let the clock run. The Roth's full benefit is available. It just requires the patience to let the clock complete. I will see you in the next one. Stay strategic. Stay furious. The Roth clock reset trap was built for the retiree who assumed that tax-free meant immediately tax-free, regardless of when the account was opened. Check the date. Check the clock. The 5 years matter.